Welcome. This is November of 2019 and another edition of the Zacks Ultimate Strategy Session, just one of your benefits as a Zacks Ultimate member. This month, Ben Raines and Maddie Johnson see if they can agree to disagree on video streaming wars, focusing on Netflix and all of the new competition that surrounds them. Sheraz, Mian, and Kevin Cook have the portfolio makeover. Kevin Matras, more answers to questions from the Zacks mailbag. And there's top stock picks and more as always. But first, Sheraz, Mian, and Kevin Cook check in with their fundamental and technical market views.
Hi, this is Sheraz Mian with a fundamental view of the market. I have organized my points as an interplay of bull and bear arguments. So let's jump right into the bull side of the argument. The top point has to be the outlook for the U.S. economy, which has weakened a little bit relative to what we saw last year, particularly on the factory side, but still remains pretty strong. As we saw with Friday's jobs numbers, the labor market remains very strong, which is boosting confidence and spending trends. The Fed has gone to the sideline a little bit, but still remains very market-friendly and supportive. And it's not just the Fed. The outlook for the European Central Bank and Japan also remains favorable. Valuation overall in the aggregate is far from stretch. It's not cheap either. The market's currently trading around 17.6 times. The high over the last 5 years has been north of 19 times. Given the interest rate environment, I don't think valuations are worrisome. And the trade issue has been with us for a while. I don't expect this issue to go away in the near term, but I strongly feel that the optimism in the market on this issue is grounded in reality. So if we go to the bear side of the argument, the list of worries are all familiar to us. There's the trade issue, there's interest rates, and the most worrisome part, in my judgment, will be this global growth issue, particularly with respect to China, and then the outlook for Germany currently weakening. The Fed, as I mentioned earlier, is both a strong point as well as a source of uncertainty for the market. The Fed, at its most recent statement, indicated that it'll be watching, and given the inflation backdrop, it doesn't see a need to be immediately doing more through the rest of the year. That's I believe is a valid stance right now, but it still remains a source of uncertainty. And then China, Europe, and elsewhere, the growth for those markets is a source of uncertainty for earnings outlook. And as regular folks know who read my commentary on the aggregate earnings picture, earnings are expected to be flat this year. There's high single digits growth expected next year, but that could be at risk of downward revision. So if we put it all together, I don't buy into the late cycle worries. I think there's no recession on the horizon. The global growth issues are valid, but the outlook for the U.S. economy remains favorable, and it's reasonable to be optimistic about the trade front. And as long as the outlook for earnings remains stable and don't come down in a meaningful way, I think it's fair to be optimistic in the outlook for market. We are at an all-time high right now. I expect the market to continue making gains over the next 9 to 12 months. I don't expect a straight line upward move, but the overall trend line should remain positive in my view.
Last time we did this, I told you that a breakout above S&P 3000 would get us to 3,300 into next year. probably 3,500 before this bull market is over. Let's go to the charts and see what's happening. So here's a 2-year chart of the S&P 500. This is absorbing tariff tit-for-tat nonsense here, early summer, or late summer rather. And then we test that with a higher low, and it's off to the races. The market does not care about the trade war anymore. Okay, let's look at confirmation of that. This is NASDAQ new highs minus new lows. And you can see what happened last December. But, just steady, lots of new highs. If you're looking for breadth in the market, you're seeing it. So, yeah, software's getting whacked lately, but other things are picking it up. And the NASDAQ has, NASDAQ has industrials, consumer names. So this is a good one to punch in. Remember this, on stock charts, you have to put in the exclamation point, then new high NAS minus exclamation point new low NAS. And you can do the same for the S&P. I could just switch this out and put in the S&P. So this continues to perform well. I mean, basically, now that the market is broken out and shaken off all bad news, and we've got a clear Fed put. I mean, last week, the Fed told us they don't even know if they'll ever raise rates again in this cycle. So they're willing to bet anything to get some inflation. And maybe we'll finally get it, but they're not going to hike into it. Okay, last thing, let's look at sentiment. So Investors Intelligence is one of my favorites because it's the newsletter writers who impact lots of people. So I was looking for these jaws to close again, the difference between bulls and bears. And so actually what we've had is an increase in bulls here to October 29th, up to 54% bulls, down 17, 18, 9% bears. These jaws won't close again until we get another big correction. And that may not happen until the spring, the way this market is going. Another way to look at this is just who's calling for a correction. This is just slipping below 30% as of October 29th. Too many people still looking for a big correction. So, that tells you that this market can just keep chugging along. Maybe we spike above 3,100 on the S&P and come back, but you want to have your watch list ready and buying strong stocks on pullbacks. All right, thanks for joining me.
Ben Raines and Eddie Johnson will see if they can agree to disagree right after this list of recent Zacks Ultimate top movers.
In this Agree to Disagree, we're taking on the streaming wars, and if any of the new streaming options hitting your screen soon are really a Netflix killer. So Ben, I know you watch TV just as much as I do, have a ton of subscriptions to all the streaming services. And as we know, Netflix has been around forever. Mm-hmm. They've been in the number one spot, and to be honest, I don't really think any of the new options are going to be a true Netflix killer because I feel like Netflix will always be around to stay with their original content and all their really great series. I don't know. What do you think?
So, yeah, Netflix isn't going anywhere anytime soon. We don't need to worry that Netflix is going to be literally killed. I think that's overblown.
No matter what the headlines say.
No matter what, Netflix isn't going to be killed by Disney Plus or Apple TV Plus or Peacock or HBO Max, but they do have to worry since Apple, Disney, Comcast, AT&T, all are much bigger, more diverse companies than Netflix. So you just have to think of, and we can even include Amazon in that mix. They just have a more diverse portfolio and a lot more money, especially in Apple and Disney's case, to play with and pour into these streaming options, where Netflix is just a streaming company, and they've been taking on a lot of debt to even finance these shows that have become a little bit more critically acclaimed. But it's just going to be hard to compete maybe 10, 20 years down the line unless they can really prove this business model out as just a streaming company.
I agree partly with that. I mean, you're right. Apple, cash rich.
Yeah.
So much liquidity. Disney, also a ton of cash. Like they have they basically have all of this extra cash to burn in order to find the best show or best movie on the streaming services. But with Netflix, they have the advantage of being able to have done it for a decade now.
Yeah.
I'm trying to think of when House of Cards came out or premiered, and that it just like blew everyone away. They had all the money going towards the cast, all that money having to pay for David Fincher, the director. And then they started rolling out like Orange is the New Black. We have The Crown, Stranger Things. So I really think it's going to take, and I feel like what people don't realize, it's going to take Apple and Disney to prove to us, the subscribers, that they're worth, like their portfolio of content is worth subscribing to. So, and I feel like it also says something that they're trying to just give it away for free. I mean, what is that telling me?
So to the price points, Apple TV Plus is coming in at $4.99 a month, which is a cup of coffee for most people.
Everyone, especially if you like lattes like I do.
And then free to anyone who buys an iPhone or an Apple Watch or other devices for a full year. So they're doing all they can to just say, here, give it a go. We'll try it out with their shows.
Right.
And it's also a really small content library, so you're paying for the 10 maybe things they even have on there for now. But the Disney Plus one is what's crazy to me. $6, and you're getting Disney, Pixar, Star Wars, Marvel. And Star Wars and Marvel are basically the only movies people are seeing in theaters anymore.
Unfortunately, yes.
And they also have National Geographic. They bought all those Fox properties for $71 billion. So they have The Simpsons. They have a massive portfolio. And they also now are going to be able to do Hulu and ESPN Plus added into this Disney Plus for $12.99 a month. That's
a
very
fantastic
impressive.
Bundle. Yeah.
Yeah.
But I think I was reading about Disney's services, or Disney service a few days ago, and I think what the biggest hurdle they're going to have to face and deal with is the licensing agreements they still have with Netflix. So I feel like Netflix has years, like a good chunk of years left to kind of like pad their content portfolio once all of the Disney properties leave Netflix. And that's not, I feel it's still like 5 years out, because Disney wrote that or agreed to that licensing deal with Netflix before they announced, or even I should say, realized their streaming dreams.
Yeah, true. And so even if all of Disney's content isn't off of Netflix immediately, the longer term thing that I see as being the problem for Netflix is right now like 70%, and this is based on Nielsen data, of their streaming viewing hours is all coming from what quote unquote library content, which is Parks and Rec, The Office, Friends, which they're losing all of those over the next couple of years, all for competing platforms. So maybe the Netflix shows have won Emmys and they're getting some critical acclaim, but I think Netflix has to prove that $12.99 or $15.99 is going to be worth it for just Netflix shows, which in 5 years, 10 years is really going to be what it is. It's Netflix content versus whatever Disney has, whatever Apple has, whatever HBO has. It's who can actually justify being like, I want to watch this show, which HBO has proven for 20 years that if you have those couple hit shows, people will pay $15 a month just for that.
Yes. And I am an HBO subscriber. I love HBO now. I will most likely just say take all my money to HBO Max because, like you said, HBO is a proven 20-year platform for premium content, and I'm willing to pay that much. Netflix, at $12.99, that's the current price, right?
Yeah, for the 2 screens.
The 2 screens. I feel like I just won't give that up. And maybe I do like all of the Netflix shows, and I do like the library of movies that they come out, but it's not going to be, I'm just not going to give it up if they're going to even increase their prices anymore. I feel like I'm similar to a lot of subscribers too, because Netflix is like the anchor to like how you stack your streaming services, whereas Disney and Apple, like Disney Plus, Apple TV Plus, they're kind of just add-ons. And I also don't think they're going to stay that cheap forever.
Yeah, that it's kind of that initial
It's that
push.
initial, exactly, to like get you in the door, feel like what the morning show is like, what C is like with Jason Momoa. But the more, as we've seen with Netflix, the more you spend on original content, the more money that costs, and eventually the base price of the streaming service is going to go up.
Yeah.
So I don't.
I think in the end, the whole argument comes down to who is going to actually have the content there in a market that's more crowded than ever in the next year or so. And if you don't have the shows, people aren't just going to be like, oh, well, I had Netflix. I'm just going to keep it even though I don't watch anything on the platform. So if Netflix can prove that their shows are worth watching, then they have nothing to worry about. But if Disney and Apple and Comcast and AT&T just have better programming, I mean, in the long run, that's all it's going to come down to.
And I want to also take this moment to imagine, or think about what streaming has evolved into, right? There's so many options. It's really saturated. There's honestly too much content I can't keep up with, even though I want to watch all these shows, watch all these movies. It's almost like it's overwhelming at the choices. So I feel like eventually we're going to have that bundle option, right? So we saw it with Disney Plus. They're doing Hulu and ESPN Plus for a great deal. I'm going to admit that's a fantastic deal for all of that content. But what about all of even the other premium channels like Stars and Showtime? They have streaming options too, and you're like, well, I do like that one show, so should I pay the $9 a month? Or are these companies going to end up making deals in the future where if you pay for Netflix, you can add on HBO or Apple for this reduced price, and now you're only paying $20 a month for all of these services? Ideally, that would be great for me and my wallet. But they just have to, I don't know, partner up and be like, what is the best decision for the consumer in the end?
Yeah, and we've been talking about these streaming wars for, it seems like a couple of years now, but it's really just about to start. I mean, Apple TV Plus launched Friday, November 1st. Disney Plus is coming November 12th. Peacock and HBO Max are next spring. And then it's really all just, who knows? I mean, it's like I said, it's going to come down to, do people want to pay money to watch your one show? I mean, HBO's done it with The Sopranos to Game of Thrones, and besides that, you never know.
Well, I don't know about you. Are you going to subscribe to any of the new services?
I have the new iPhone, so I'm going to watch the Apple TV Plus. I have not watched any of the shows yet. Mixed reviews, but we'll see. And I will definitely have to try out Disney Plus just to try it, no matter what.
I'm definitely in the same boat with you on Disney Plus. I think I'm going to skip Apple TV Plus for now. None of the content intrigues me enough to even pay the $5 a month. But Disney Plus, it's like, I kind of want to see what all the hype is about.
Yeah.
But I also don't know if I'll continue to pay the $6 or $7 a month just so I can watch WALL-E or Tangled or Aladdin when I can just maybe rent it on Apple or Amazon for the $2.99.
Okay, yeah.
So, I don't know. That's my thoughts. And we'll see what Netflix can do, how they can shape up to the competition. And honestly, how it's going to affect and impact Netflix's stock, especially now that we have all of these streaming services available. Same goes for Disney stock, for Apple stock, Amazon Prime too, Amazon stock, excuse me. So, I don't know. I think we've eaten up kind of a lot of time here talking on streaming services. So, That's it. Thank you for watching Agree to Disagree.
Ahead of the Zacks mailbag, here's this list of recent Zacks Ultimate new additions.
Hi, I'm Kevin Matras, and this is the Zacks mailbag. So, this week's question is, with stocks making new all-time highs, should investors get in or wait for a pullback? Well, first off, I'd say if you're not fully invested yet, what are you waiting for? This is an historic economy and an historic bull market. Why aren't you fully taking advantage of it yet? Our economy is strong, with full-year GDP pacing at a stronger rate than the average annual GDP of this entire 10 3/4-year expansion. Unemployment is at its lowest level in roughly 50 years. Consumer confidence is near record highs, a very important metric to watch given that 70% of our GDP is tied to consumer spending. Corporate earnings continue to impress, and interest rates are low, with the Fed having just cut rates again last week on October 30th. And I should note, too, given all of the Chicken Littles earlier in the year talking about a recession, not us, it should be noted that over the last 50 years, there has never been a recession when the Fed funds rate was under 4%. And right now, the midpoint for the Fed funds rate is 1.63%. Moreover, the United States and China are preparing to meet and sign Phase 1 of the long-awaited U.S.-China trade deal in mid-November. So again, if you're not fully taking advantage of it, what are you waiting for? Now, if you are fully invested, congratulations. You're going to look back on these times with great pride, having correctly analyzed the market and reaping the benefits. And I think there's a lot more upside to go. Let me also say, don't be afraid of the market just because it's at new all-time highs. Instead, get excited. Statistics have shown that stocks making new highs have a tendency of making even higher highs. In fact, going all the way back to the 1950s, it shows that stocks typically go up in the subsequent 6 months following new all-time highs. This means that stocks making new highs aren't at any greater risk of going down. Quite the contrary. There is a higher probability of stocks going up even further. Now look, I know some people are reluctant to buy stocks after making new highs. I suppose they may feel like they've missed the move, or, now stocks have more room to fall. I get it. But again, stocks making new highs are a good thing, not a bad thing. Just think about your portfolio. If somebody were to ask you what your best stocks were, you would likely name the stocks going up the most in your portfolio. And your worst stocks, those would be the ones going down the most. And I'm pretty sure the person who dislikes buying stocks making new highs wouldn't be too upset if the stock he or she already owned broke out to new highs. And why should they? These are the stocks we all dream about, getting in and watching it go up. And just think for a minute, can you imagine all of the money you would have left on the table if you were afraid of being in stocks every time they made a new high? You wouldn't own any of your best performing stocks right now. You would have gotten out of the S&P back in April of 2013, 6.5 years ago, when it made its first new high of this bull market. You would have left over 94% of additional gains on the table, not to mention its dividends, and you would have missed out on tons of other stocks and their double-digit, triple-digit, and even quadruple-digit gains. So don't be afraid of stocks making new highs. It's an irrational fear, not supported by fact. It will cost you a fortune in missed profits. And don't wait around for some magical pullback to get in either. I mean, how many pullbacks have you seen so far this year? Plenty, right? And if you didn't take advantage of them back then, why do you think you'll suddenly take advantage of the next one, if you're even lucky enough to get one? If you think the market's going higher, just get in. Right now, we're in a confirmed bull market, so there should be no question as to what to do. Let me also remind everyone, too, that the longest bull market on record was 12.3 years for a 582% return. And right now, we're roughly 10 3/4 years and 360% into this bull market. Historic events often produce record results, and we are clearly in historic times right now. I believe these historic events will lead to a record-breaking bull market in both length and magnitude, and that means we have a lot more upside to go, both in time and price. So make sure you're taking full advantage of it.
Sheraz, Mian, and Kevin Cook return with their portfolio makeover. But first, these interesting insights from Zacks Ultimate Editors.
Portfolio makeover time. Got a ton of great submissions. So Sheraz and I picked two, and I'm going to let him start off.
Sure, very good. Well, thanks, thanks, Kevin. The one I'm going to talk about, we have it on the portfolio tracker here. This is from Elaine, and as you guys could see, it's about 11 stocks. All the major names here, Kevin. You have Apple, Microsoft, Lam Research, some lithium motor. There's a REIT there. I like the portfolio overall. If I have one issue with this, would be the complete absence of finance. When it's not a diversified portfolio, my issue always is it part of a strategy that this investor is staying out of a particular area or overloading on a particular area? If it's part of a strategy, that's perfectly fine. These are good quality stocks. Isn't Tiffany is one of the stocks here?
Yes.
Isn't it being acquired?
Possibly, yeah.
So,
Had great news last week. Stock was up quite a bit.
So overall, I like it. It's a little bit on the small side, I think. 11, 12 stocks. I think it doesn't lend itself to full diversification. But on the positive side, it's relatively easier to manage, and it doesn't become as problematic as 2530 could very easily become.
Yeah, and what she nailed here, if you look at my screen, is for only picking 11 stocks, really good diversification.
Absolutely.
Yeah,
that's right.
Except for finance, as you mentioned.
That's right.
And except for healthcare. There's no healthcare here. So it's like if somebody were, I like this mix here of retail and tech, and you got a logistics company and a REIT, and then lithium motors. Throw in some healthcare, maybe some finance.
Sure.
All right, I'm going to take over with MP's portfolio here.
Okay.
MP had a few more holdings. So if you look at my screen here, you can see Amazon and Baba at the top. This is obviously alphabetical, but they are some top of the world stocks to own if you're going to play globally, Amazon and Alibaba. A cloud computing ETF, boy, that's the way to go lately with the
Absolutely.
with the wreck
That's right.
of the SaaS companies lately. Energy, Fortinet, security, I like that. GBTC, the Bitcoin Trust. Not really a fan of that, but it's if somebody's trading it and buys it at $5 and sells it at $10, I don't have a problem with that. I just hear that it trades at such a premium.
That's right.
And it has a high fee. He's also got the Hack ETF. Can't go wrong there if you want exposure to the cybersecurity companies. Now, this one I thought was really interesting. I was going to say, oh, this portfolio doesn't have any healthcare either. But what MP has done here is bought the Robo Global Healthcare Technology and Innovation ETF, sort of like the ARC family of innovation ETFs. And I really like this idea. And I took a look at what Robo Global holds in their healthcare innovation ETF, and some names that I really like: Illumina, Penumbra, obviously Intuitive Surgical. So this is a neat way to go if you're just getting into you're getting into healthcare and you don't want to take biotech risk, that kind of thing.
Yeah, the SID, I believe it's a Latin American steel company,
Yeah.
and then the Vail. There's West Management there too, so there's a decent amount of conventional basic materials type of exposure in this portfolio. There's the lithium battery ETF too. So I think the issue I had with Elaine's portfolio in terms of missing finance, that issue is here too with MP. But overall, through this nice mix of ETFs and some quality stock holdings, there's a fair amount of diversification here.
Yeah, and this investor has recognized, the power of ETFs, giving you exposure to a specific industry or sector. Sure. Maybe you get some alpha and outperformance out of that.
Sure.
Without company-specific risk.
That's right.
So,
and it has a fair number of not commonly remembered and named names. So this Bitcoin stock, the MongoDB.
That's a SaaS database company.
Okay, so I would think that there's been some fair amount of looking around to find these stocks. Fortinet is there too.
Yeah.
So a good mix of stocks, I believe. A little bit weighted towards tech, but that's where the growth is, and that's where the outperformance has been. I believe most of these stocks must have done really well this year.
Yeah, I mean, some of the software things have gotten crunched, but
on the whole,
yeah. But I think that something like MongoDB, even though it's a rank 4 right now, it is probably something to accumulate under $125.
Sure.
All right, that's it for another portfolio makeover. Love for you guys to send your additions. Oh, the one thing I didn't mention, the portfolio that I took a look at first, MP, what I liked about it, and I had to pick it, was because he sent me his allocations. So he broke out the portfolio, 4% here, 5% there. A couple things were 10%, but I like to see that because that means investors are thinking about what is my real exposure across an entire portfolio. All right, thanks for joining us.
Here are a few things you can expect to see coming up. The mobile app includes features just for Zacks Ultimate members. In addition to having access to real-time pricing data from BATS, you can opt in to receive trade alert notifications and service updates for each portfolio you follow. Plus, be sure to check out the latest version of the 7 best stocks for the next 30 days weekly report, where Zacks experts reveal 7 stocks handpicked for immediate profit potential, posted on the Zacks Ultimate homepage. And remember, the next Zacks Ultimate Strategy session is going to be posted in early December. So start thinking of submissions for the Zacks mailbag and portfolio makeover segments.
My top pick is CRISPR Therapeutics. It was up 30% for us last week in Healthcare Innovators on big volume. And I'm not leaving. All right? They gave a company presentation. Well, they reported last Monday, but they gave a detailed presentation, pipeline update, strategic updates, and the good news was endless. Let's go to a few slides from that company presentation you can find on the website. First, a broad overview of what CRISPR Therapeutics is all about, the specific diseases they're going after, and with certain technologies. We'll talk about hemoglobinopathies. We'll talk about CAR-T. So next slide here. About sickle cell. The red blood cells are misshapen. They have trouble navigating through the bloodstream. and functioning properly. And then there's thalassemia, beta thalassemia. These are the two hemoglobinopathies that CRISPR is going after. They are entering phase 1, phase 2 clinical trials, enrolling right now. You can see over there on the right-hand side, 300,000 babies are born every year with sickle cell and 60,000 with beta thalassemia. All right, here's the pipeline. Lots of good stuff going on here. And the updates the company gave last week really got investors excited. That's why if you weren't long the stock, you were chasing it up above 50. And note, who's the big brother pharma partner here? It's Vertex. And Vertex, let me just explain this. So Vertex also announced new partnerships and agreements. Some of the ones that Vertex had with CRISPR expired in 2015, and they launched new ones. So part of the reason the stock was up is that Vertex is revalidating the science and the pipeline here, and also losing a little bit of control. So some people were speculating, Vertex it needs to buy CRISPR to get control of this. I don't think that's necessarily true. They still have access to this stuff. Okay, but down at the bottom you can see Vertex is the king of treating cystic fibrosis, and big news there recently for them. But they are also collaborating with CRISPR on diseases like Duchenne muscular dystrophy and CF. All right, finally, let's look at the patents. You always hear me talk about Editas Medicine as having all the patents and having the most upside. Well, CRISPR's not doing too bad here. You can see dozens of patents here in the U.S. and in Europe that will make a difference. Okay, final word. We're talking about a company still under a $3 billion market cap at $50. They've got $630 million in cash. They're not going to be doing a raise anytime soon. So my recommendation is buy this when it dips into the 40s, say 45-ish, and be ready to buy it if it dips lower. Last December, during that stupid rout in the stock market, CRISPR went down to $25, and we bought it in Healthcare Innovators there. So you always want to be buying this on the dips into the 40s. Save a little bit if you get a dip back to 31. We bought it twice at 31 in the past 2 years. And Piper Jaffray has a $100 price target on CRISPR because they've got a partnership with Bayer. But the upside for this science is fantastic, and it could be as well for CRISPR. All right, thanks.
Hi, Sheraz Mian with the top stock pick, and my pick is Dollar General. As you can see on this slide, the stock has had an impressive run this year, up 41.6%. And these gains are driven by the company's market share gains and late cycle attributes. Dollar General and others of its peers have always had this reputation for being good performers in the case of a downturn. It's a high quality growth story, as you guys could see here. They have a footprint of 16,000 stores. They're adding about 900 annually, and that growth should continue for the foreseeable future. Every new store becomes cash flow positive in 1 year. It has a lot less exposure to online-only competition, and the reason for that is the mostly rural nature of their footprint, about half of the transactions being cash, and the two-day delivery option is just simply not as compelling for the DG customers as it is elsewhere. I mentioned the late cycle, the counter-cyclical attribute, which is an amazingly important attribute for the stock, and it isn't cheap, but it isn't nosebleed expensive either. To put it all together, the focus on small population center marketplaces is a source of competitive advantage for the company. A long-term same-store sales in the 2 to 4% range should be sustainable on the back of investments in stores and merchandise, and initiatives in distribution and operations should continue to expand margins, if not at least sustain them. The sum total of all of this is showing up in positive estimate revisions for Dollar General. The stock has had, as we mentioned earlier, an amazing run, but I see it as a quality long-term holding and not a short-term tactical pick.
Well, that's it for this edition of the Zacks Ultimate Strategy session for November. We hope you found it interesting. You know, feedback is always welcome, and you can send that to mailbag@zacks.com. If you have any questions for the Zacks Ultimate service itself, you can always contact your account manager at ultimate@zacks.com or by calling one of a couple of phone numbers. First one, 888-775-8348. International callers, use 312-265-9309. Until next time, thanks again for watching. Thanks also to our technical crew for helping produce this. And as always, we look forward to sharing success with you for many years to come.